All right, welcome everybody to today's episode of Sip and Style. I am joined here by a finance expert, Michael Sarafian. We are super excited to have him on the show. He's going to teach us a little bit more about finance, how to steward your money really well. So I'm excited to have you on the show, Michael.
Thank you very much, TJ, for having me.
Of course, man. Tell me a little bit about your background, how long you've been in finance.
Yeah, absolutely. I entered this industry in 2018, and, my original pursuit was to become a dentist.
Right.
I followed the typical Armenian doctor-lawyer path, and, my grandfather and uncle were both doctors, so I went down this path of pursuing pre-dental, and ultimately, when I graduated, it wasn't my calling. I didn't want to do something for the wrong reasons. I discovered finance the summer after I graduated college, and that summer, I fell in love with the subject. I probably read hundreds of books, tens of books. I probably got at least 50 rejections trying to get into the industry, with the science background, not the easiest. But at the end of the day, I'm self-taught financial advisor, and I never looked back. I'm very grateful to have made it here and be in a position to serve others. What a privilege it is. Yeah, I'm very grateful.
100%. What was it about finance that drew you to it when you were initially studying for dentistry?
Finance is such an all-encompassing subject.
Yeah.
There's so much psychology.
Yeah.
I always tell my friends, you could be the greatest investor in the world. You could be Warren Buffett. You could be all these things. But if you don't understand at the end of the day behavioral finance, emotions, and the psychology behind the investments, it doesn't mean anything at the end of the day. Because all professionals, including myself, we may be trained experts, but even us get emotional, especially with what's going on now in the markets.
Right. Yeah, no. So, as far as your style of finance or trading, forgive me, I am not that educated, so I don't know, if there's any, differences between this, this hedge fund or this. But tell me a little bit about your style and how you like to invest.
In today's day and age, there's so much noise, especially with social media and friends, and there's too much stimulation of various investments and ideas, and it's very hard. It's very easy to get caught in all that. At the end of the day, I like to keep it very simple. One of the best strategies for success is simplicity and long term. The whole goal here is for it to be boring, take the emotions out, be consistent, stick to your investment strategy, don't abandon, don't sell early, don't stop investing. Keep it simple, keep to a few funds, stay long term, let it be boring. And over time, compounding and magic will work in your favor. Yeah,
compounding interest is obviously a very fascinating topic for everybody. So, you talked a little bit about how you got into finance from dentistry. Since you've been in finance, what's been the most rewarding thing for you?
It was what I said earlier. One of the first things I said, nothing brings me more joy than empowering people.
Yeah.
What makes me very different from the average financial advisor is I listen to people. I'm not here to be a professor and a lecturer. I want to get to know you. I want to get to know exactly what your needs are. Once I have a good understanding of your needs, I want to convey the messaging and the recommendations and the financial planning in a way that you understand.
Right.
If you don't understand the strategy, what purpose is this privilege I have?
Yeah.
And to your point earlier with compounding, Einstein said it is the eighth wonder of the world, and I'll tell you why. I'm going to give you 4 age groups. I'm going to give you a 25-year-old, a 30-year-old, a 35-year-old, and a 40-year-old. These 4 age groups are going to start investing for the first time in their life. They're starting with $0. The 25-year-old, 30, 35-year-old, and 40-year-old. Let's say each of these cohorts invest $500 a month. And each of these cohorts are going to invest until they're 65 years old. That's kind of the standard retirement in this country. Right. Okay? So obviously the 25-year-old, having started the earliest, has 40 years to the timeline. The 40-year-old has only 25 years. So just to convey the magnitude of compounding and the urgency and need for all of us to start earlier than later, the 25-year-old, having started the earliest with that trajectory, at 65 years old would have around $4 million.
Wow.
The 30-year-old just having started 5 years later. 5 years later.
Yeah, not that big a deal, right?
Not that big of a deal, right? But it is a big deal.
Yeah.
Instead of 4 million, it's 1.7 million.
Wow.
The 35-year-old, instead of 1.7 million, is about 1.1 million. And the 40-year-old is about 700,000.
Oh my gosh. Yeah, so 5 years makes a huge difference.
5 years makes a huge difference. And if there's one takeaway that the listeners get from this, it's start earlier than later and let it be boring.
Well, you know what they say, the best time to plant a tree 20 years ago, the second best time is right now.
Exactly.
So, I mean, if you're interested, definitely get this guy on the phone. But I'm very curious, like, so your style is very conservative, sounds like. Do you ever get into any risky investments?
Yeah.
Do you like risky investments?
I do.
Do you like playing the long game only?
Absolutely. What I tell a lot of the people I work with, the name of the game here is to learn business cycles. The business cycles are this, markets, they hit a top, it gets too heavy, they fall, they hit a bottom, and it repeats. With us, with the time frame and time horizons we have in the next few decades, we're going to see multiple retracements, multiple recessions. Translation, multiple buying opportunities. Back to my point earlier of being very different than the average advisor, I have to fight with other financial advisors so much to incorporate the new ideas in this day and age, particularly crypto, particularly AI, all these things, but especially crypto, I think is going to change the world for the better. And one of my brokers, one of the few brokers that can incorporate crypto in the said investment strategy, and I think that's very important to consider as part of your investment mix. That's lacking.
So what is it about crypto that you think is going to change the finance space?
So, there's this big debate in crypto. We call it the Bitcoin maximalist. Bitcoin is the biggest crypto. A few weeks ago, it was over 2 trillion in size. Now it's definitely come down quite a bit. And then you got all the other cryptos. Once you embark past Bitcoin into the other cryptos, it's very speculative, very risky. It's a total different game.
Yeah.
But to answer your question, I am a Bitcoin maximalist for the most part. This is the ultimate devaluation play, because here's kind of the reality of the environment we're in. You don't want to depend on the government. You don't want to depend on your parents. You don't want to depend on anyone. With all the money printing going on, you only have yourself to worry about in your family. And if you don't own stocks, if you don't own crypto, if you don't own these ideas sooner than later, then you're going to get left so far behind in the decades to come. Let me put it to you another way. When I'm doing retirement planning, if I had to put a number out, ideally $1.5 million to 2 million today to retire, ideally.
Yeah.
Let's say when we go to retire, it's going to be more like 3 to 4 million.
Yeah.
That's what crypto is. It's a devaluation play, just like real estate, just like stocks, just like gold.
Yeah, I mean, as far as for me, like when you say it's a devaluation play, what does that mean to you? Like, so obviously I'm uneducated on all this. What does that mean? Devaluation play.
Great question. Let me put it to you like this. The dollars in your pocket.
Yeah.
Those dollars have no ceiling. The government can print, the Federal Reserve can print, other countries overseas can print. The answer to all the problems all these sovereign nations today are going through, their answer is not to cut benefits. It's not to address the problems head on. It's more to put a Band-Aid and just print more money and give people checks.
Yep.
When you do that, it creates devaluation. It creates asset inflation.
Yeah.
So here's kind of the reality. This is what I tell people. When you invest in stocks, crypto, gold, real estate, things like that, they will inflate at a higher rate of return than consumer inflation.
Yeah.
So for example, my stocks will go up probably 2 or 3 times that of the rate of the grocery store prices or living inflation, whatever the case may be. Devaluation, excess money printing, it creates asset inflation, which inflates more than consumer inflation, which is why the rich get richer and will continue, unfortunately, in this environment.
That's incredible, and that's, I think, very true. So you said that's why the rich get richer. I mean, tell me more about that. Like, dive deeper there for me.
Yeah, when I am talking with people, I'm gauging their financial literacy and, more importantly, their relationship with money. If you're under the impression that money is bad and it's not for me and rich people are bad, you already have a poor mindset. Money goes where it's treated best. And
I like that.
It goes where it's treated best.
Yeah.
And if you're under the mindset that you're prepared to work hard and add value and do good to others and be ethical, you'll be rewarded, hopefully, with opportunity. And it's your ability to grow that money.
Yeah.
To your question, as far as what that means, the rich getting richer, the rich essentially always take advantage of opportunity. They don't miss opportunity. You know what I said a few moments ago about learning business cycles?
Yeah.
They always buy low and sell high. They're always ready to take advantage of a sale, a recession, a real estate sell-off, whatever the case may be.
I've heard something recently, and having yourself here kind of makes me curious about this. The buy low, sell high mantra is actually a bad way to invest, or a bad way to consider how you're going to go about trading. The best way to do it, supposedly, and maybe this is wrong, but best way to do it is to buy low and borrow against those assets.
Yes, well said. The saying that wealthy people adhere to is buy, borrow, die.
The buy, borrow, die.
So here's kind of the idea you just mentioned. Wealthy people, they own assets. They're not going to sell their assets when they need liquidity. When they need money, they're not going to pay capital gains.
Right.
Rather, to your point, they borrow against their assets. When you borrow against your assets, you don't pay taxes.
Right.
You don't pay taxes. You get to write off the interest expense that is accruing, so it becomes a deductible expense, and it allows you to have leverage and to be able to buy more assets.
Yeah. I hear that, and I always wonder, how do I do something like that, right? Like, I have some assets. How do I borrow against them? And what happens if I borrow against them and it goes, the stock goes down?
Yeah.
What does that look like? Is that bad for me as the investor who's borrowing against that asset? How does that work?
Yeah, good question. Part of your success as any investor is having the right team behind you. I'm with my business partner and CPA, Skyway CPA. We bought real estate together, and this is what we did, to your point, as far as how you execute this strategy. We own multiple rental properties. We have a stock portfolio. We simply borrowed as a line of credit against our stocks. The beauty of this is we didn't have to sell the stocks, and the stocks today are a lot higher.
Yeah, you still keep the assets.
Yes.
Yet you're borrowing against them. You have the cash flow to be able to go and purchase new assets.
That's right. And you buy the real estate. You're in the meantime of buying the real estate, I'm writing off the interest expense from the line of credit. I'm writing off the depreciation from the real estate. The game just continues as far as paying the least amount of taxes and building the empire. But at the end of the day, you need a strong team behind you.
Yeah. Okay. That actually kind of brings up another topic in my head, something a little kind of going back to what we were talking about briefly about the economy and kind of where it's at, and being not necessarily in the best place because of inflation and constant printing.
Yeah.
Something maybe a little bit better. I recently watched a video about how each reserve currency eventually, after about maybe 100 years in power, will go away and will eventually shift into something else. And we're actually in supposedly stage 5, 7-stage process here where the reserve currency goes through. Is that true? Are we kind of on the precipice of the U.S. dollar kind of being not the reserve currency?
That's such a great question. I'm glad you brought that up. Anytime you speak to currencies, you can't ever make a general statement and say this currency is doing this. It's always relative to the other currencies. So, for example, yes, to your point, the Bretton Woods Agreement would suggest that the dollar, every 100 years, the reserve currency collapses. But it's always, as any wise investor, you need to be prepared to play the devil's advocate, the opposing answer to that statement. So kind of look at it like this. At the end of the day, as much as we may print America I never bet against America. Other countries print considerably more relative to us, and we have the best innovation in the world. We have the best treatment of capital. All the capital is flowing here, given our low corporate tax rates, lower regulations and whatnot. So look at it like this. It's kind of like there's a term for this. It's called the dollar milkshake theory. The dollar milkshake theory. So let's say, because I said it's all relative, other countries, developing countries and whatnot, should there be a collapse? Like recently we did an injection in Argentina, let's say, but let's say overseas there's a collapse in their currency because they printed considerably more than us, the United States, and they don't have the productivity and innovation to back that printing. When they fall, it creates panic, because I told you this is all emotions, it's all behavioral finance. It creates panic. What panic creates is a considerable higher demand of dollars because people flock to stability and safety. And that's what the US dollar is at the end of the day. So should countries collapse and sovereign nations collapse and have to print that much more to stay afloat, it creates a everlasting considerable higher demand of dollars for that stability. So it's not that simple. It's tricky. There's multiple factors at play. But this goes back to my point earlier, hence why I'm such a big believer in crypto, because should the dollar collapse, if it collapses, when it collapses, specifically Bitcoin is the answer to that collapse. It's the devaluation play, because it's finite. Bitcoin is finite. The dollars in your pocket are unlimited and will always be unlimited.
Yeah, that's very interesting. It's, I was kind of watching this video thinking, the collapse of the dollar is happening in the next 20 years. Because, the dollar really kind of rose to stardom in 1944.
Yes.
Along the same principles and with the same mindset and theories from before, and just looking at history.
Right.
We're about 20 years away from that, which, is scary. If that was the case, in general, what do you think is a safe place to be putting your money?
I would have a diversified mix of assets. The best investment you can make is yourself.
Yeah.
Your business.
Yeah.
Your family, your stocks, your crypto, your real estate. Of course, there's a distinction between scarcity, and certain assets are more scarce than others. So for example, with Bitcoin, for sure it's finite and truly scarce per the code. There's 21 million.
Yeah.
And currently there's 95% already minted. So a little bit, 19 and a half, 20-ish million. That's a scarce asset. Your real estate building, scarce asset. Gold, scarce asset. And at the end of the day, if you own these scarce assets, you will be rewarded over time if you're prepared to wait, because there's so much psychology in this game. I can't tell you how many times I've seen investors have a correct thesis on a certain asset gonna come to fruition and appreciate, but they abandon ship too early.
Something goes wrong, and
they don't have conviction.
Yep.
You got to have conviction in your thesis and stick to it.
Yeah.
And that's the reality. This is supposed to be boring, but TV, social media, YouTube, it makes it exciting, and it's very easy to get lost in the noise.
Yeah, it's very easy to get emotional about, you have a theory and maybe you start investing into it, and then the second, something goes awry from your theory, do you panic and get rid of, or do you hold strong? 100%. What are some strategies to kind of like avoid that psychology, that fear, or that emotional buy and sell? Like, what is some strategy you employ to keep yourself from doing something like that?
Great question. There's a couple strategies. For the do-it-yourself investor, there's a saying: concentration amasses wealth, diversification keeps it. If you're early on in your stages, if you're younger, maybe concentration is the play, whether it be your business, whether it be a few select investment ideas, whether it be real estate, whether it be just stocks. That might work very well. Once you make it, once you're comfortable, diversification can keep your wealth. At the end of the day, to your question, it's going to involve time, making mistakes, and starting earlier than later. And if you're not prepared to have that discipline and do these things, the best suggestion is to outsource it, like a lot of the clients I work with. That's kind of what I like to tell people is I'm the quarterback of your financial affairs. I have my team behind me. When you hire me, it's not just the team, it's my CPA, it's the estate attorney I work with. In other words, the A team, accountant, advisor, attorney. You need to have a team behind you if you're not prepared to do it yourself and learn it yourself.
Right. That's awesome. So you actually came extremely recommended from a couple of my clients who they were using somebody in finance for 30 years, and they said you've made them more money in the last 2 years than they were making in previous years with their previous hedge fund manager. What are you doing differently?
At the end of the day, I'm an independent advisor. LPL Financial, my broker, is the largest independent advisor in the United States. This means I have total autonomy. I previously worked at Morgan Stanley. Morgan Stanley was a great company, but I was at the realm of shareholders, quotas. I had limitations. Because I'm independent, about 80-90% of my business comes, to your point, of winning it from existing financial advisors. Because the average financial advisor today is 61 years old. They're kind of halfway checked out. They're preparing their retirement, and they're not doing tax planning. They're not doing financial planning. They're not incorporating crypto. They're not listening to their clients. They're not proactively reaching out. They've made their money, and they're coasting, and they see someone like me, who is a certified financial planner, having these tax discussions, these estate planning discussions, asset protection, the investments, having the accountant, having the CPA, the estate attorney, having all these things, offering that breath of fresh air and being able to deliver that. And on top of that, as an independent advisor, I would say everyone except one person this year who has been working with an existing advisor, I've been able to cut their investment fees at least by 50%, at least 50%.
And that's huge right there. You save them some money, they can reinvest that money, and that money will compound over time. That makes a lot of sense. Well, I have two more questions for you, and then we'll wrap this up. My next question was, obviously, you're on the cutting edge of all of this, I think, from our conversation. What's a low-key move that not a lot of people are talking about that you're thinking about right now that's a really bullish play for you?
I'll speak to it from a societal standpoint and an investment standpoint. I think a low-key move is, unfortunately, in our culture, there's a lot of keeping up with the Joneses. I can't tell you how many times I sit with people where on the outside they have a nice house, they have a nice car, but then we start unveiling the balance sheet and it's all debts. There's no assets to support this lifestyle. And I can't help but wonder, is it because they're catering to their friends? Is it their relatives? Are they trying to live some image that maybe it's too early to be living that image? So the first thing I would say is stay true to your own financial well-being. Right. Don't do this journey for others. Only do it for yourself and your family. In the beginning, we all have to make sacrifices, and whatever that involves, once you make those sacrifices or have that delayed gratification, you will be rewarded eventually.
Yeah, no, that's very true.
Now, to your second question, I want you to let's think 10 years out. Let's look at the macroeconomic environment, what's going on. I'm getting a lot of calls right now from clients that there's a lot of layoffs. That to me is kind of concerning me because this could be AI triggering layoffs and job replacements.
Yeah,
Now look at this environment in the next decade. Stay with me here. So if people start to get replaced and they no longer can work, eventually what's going to happen is this is going to create extreme deflation. Deflation meaning prices come down. If corporations don't need manpower or as much manpower, they can lower costs, productivity goes up, and prices come down. In our economy does not work when there's deflation. It only works when there's inflation, but the catch is controlled inflation, not runaway inflation. So to combat this issue, this future headwind of deflation, extreme deflation from AIs replacing humans, the government and the Federal Reserve is going to have to prolong keeping interest rates low, to prolong excess money printing, because this is going to end up probably as checks to people to pay them because they can't get work themselves. And you're going to have to create inflation and excess money printing to combat the deflation.
Yeah.
So I think in the next decade, as sad as this sounds, I think the rich is going to get considerably wealthier. I think this is a massive recipe for asset inflation. And if you don't own assets, you're going to get left so far behind, more so than ever. This curve of asset inflation is going to considerably go up, and this is the age to get ahead.
That brings me to my final question. Obviously, you came in here looking very well dressed. I like this suit that you're wearing. Why do you dress up?
At the end of the day, if you look good, you feel good, and you want to have every advantage you can. Part of it is, to at least match you. You're the suit expert.
Yeah.
But at the end of the day, if you look good, you feel good.
Look good, feel good, do good. Absolutely, 100%. Well, that'll do it for today's episode of Sip and Style. I'd love to have you back on, Michael, in the future, but let's have a little cheers to this great conversation. Cheers, my friend.
Thank you, TJ.
Thank you so much.
Cheers.